Okay, with the income statement historicals laid out, let's do the balance sheet. So the balance sheet is a couple of pages after the income statement we're just working on. So let's open that up here, and we're going to start plugging in the data. So the big thing is we're going to aggregate a bunch of these line items for cash as we talked about in a preceding video. So this, this 20 plus the 53 in marketable securities that are reported under current assets, and then the 194 for 2017. That's what we're going to put it here. We're going to say, okay, it doesn't like that there's commas there, but we're just going to say okay. Then we're going to do the 25, 40, and then 170. We're going to hit enter there. So you see their cash position going down a little bit, but they've got these massive cash balances that, again, like I said, I think some of you have probably heard of. And so accounts receivable, let's grab this one for 2018. We're now going backwards. So let's just to be consistent, we'll keep going with 2018 and then go back to 2017. So here I'm double clicking. So I think it's actually going to be faster to just do this rather than do the whole process that I showed you with the income statement. Vendor non-trade receivables, I actually want to bundle into other current assets, so I'm going to do that here, as well as other non-current assets. We're going to go explore what those other non-current assets might be in a second, but first let's just kind of do the heavy lifting of actually putting this in. And unfortunately, this is an unglamorous exercise. All right, property, plant, and equipment. Other non-current assets. And because this is, you can see this is a manual exercise, and the fact that especially I didn't lay it all out the way I did for the income statement makes it even more error prone. So it's critical that you check that you did this right. 365, 725 for 2018, yes. 375, 319, yes, I did that right. Now, as promised, I also, whenever you see line items like other non-current assets, it's always good to sort of understand what the nature of them are. I'm actually going to defer trying to look in the footnotes what this is all about until I get to the forecasting, because that's when I'll be able to kind of have interesting ideas about whether I forecast it with revenue or whether I straight line or whatever. So let's keep going down the list. So I got accounts payable, and I'm going to grab accounts payable from 2018. Deferred revenue, I'm looking for both current deferred revenue and non-current. So let's put both of those in for now. So let's go for the current and non-current deferred revenue. Now, once I put this in, I think deferred revenue is an interesting line for a lot of companies, and Apple is no exception. So I think it's worth talking about, because unlike some of the other line items, sometimes this doesn't stick after the first year of accounting. So we're going to finish this up. Commercial paper. So Apple's got commercial paper reflects really short-term borrowing that companies have. So it's got $11 billion in commercial paper, both years, around $12 billion, I should say. Notice we're calling it commercial paper / revolver. I'll talk about why. This is more of a financial modeling mechanics. We need to basically repurpose the commercial paper line when we're forecasting to basically be a model plug that says, you know what, if you have any cash shortfalls, we're going to use this line to borrow more to deal with those cash shortfalls. So we're going to label this revolver, even though the company doesn't call it a revolver, it calls it a commercial paper. We're repurposing it from forecasting perspective to be our revolving credit line, which is the model plug. Long-term debt, they have almost $100 billion of long-term debt. If we include the current portion, we actually get to more than $100 billion. So this is debt that's due this year that is long-term, as opposed to debt that is long-term that's not due this year. Other non-current liabilities. I think this is the last of the liabilities, so then we can have a nice discussion. let's make sure we calculated this all correctly. So 258,578, yes, 241, 272. Okay, so we did the numbers right. So now let's just briefly talk about deferred revenue, both current and non-current. So deferred revenue represents cash you've received for selling your products or services that you haven't earned yet. You can't quite recognize as revenue. And so for Apple, you can think there are really two things that are driving Apple's deferred revenue. The big thing is the fact that it sells iPhones. And when Apple sells an iPhone, let's say let's put this off to the side. So Apple sells an iPhone for $800. Apple gets to put, this is the retail. There, so what the journal entries are, Apple gets $800 of cash on day one, and they recognize revenue under retained earnings. It's part of revenue, right? In retained earnings of not the full 800. They might recognize something like 790. And if you're wondering why, think about the definition of revenue, the core principle of revenue recognition, which says you can recognize revenue when it is earned. Well, when Apple sold you the iPhone and presumably shipped it and you received it, Apple earned most of its revenue. But remember, when you have an iPhone, you've got implicit software upgrade rights that you get just by owning the iPhone. These are services that Apple needs to keep delivering to you. Apple has to estimate the value of those, and let's say Apple estimates the value to be around $10, and Apple does have some leeway around how much they estimate. Last time they actually published, I think several years ago they actually published what the estimate was, and it was something in this ballpark, $10, $15, where they say, you know what, 10 of this is actually not we don't earn right away. This has to do with the implied future software upgrade rights that then we assign a 2-year useful life to, which is sort of what they do. They assign a 2-year useful life to most of the Apple iPhone software upgrade rights. So they say, okay, on day one, what's the journal entry? Retained earnings is 790, cash is 800. Well, what's missing is a liability called deferred revenue. That's the plug here that basically says, okay, well, there's that missing 10. The missing 10 is a liability, and it's a liability in the sense that over the next several years, let's look at that. So after, so this is at year 0, right, at purchase, and then at year 0, or at year 1, after 1 year, let's be explicit about this. So after 1 year, the deferred revenue, let's fix the spelling in this, for that iPhone, that liability goes down as Apple recognizes an additional $5 in revenue. Now, no cash has come in from that iPhone, and the same thing in year 2. So after year 2, the liability again goes down, and now the liability is 0, and Apple has recognized 5, right? So there's a decline here of 5 and an increase of revenue here, and another decrease of 5 here and an increase here. So now you understand what deferred revenue is, at least in the Apple iPhone implied software upgrade rights issue. Apple, of course, also gets deferred revenue from gift cards. Imagine if it sells an Apple gift card for $100. Apple gets cash of $100, but it can't recognize any of the revenue yet. It recognizes 0 in revenue from a gift card. It recognizes it as it is earned. And so let's say over the next 2 years, the person who had it actually used it. Apple recognizes the revenue only as it earns it, right? So these are the two big things that are driving Apple deferred revenues. So we decided from an analytical perspective, the way we're going to forecast it doesn't actually matter whether Apple expects that this deferred revenue will reverse in the current year or in the future. We're going to lump them together. So long story short, that's why we've got them both together. Now let's take a step back. As I mentioned in earlier videos, it's always helpful to take a step back to see the forest for the trees. And now you can see that Apple is a company that more than half of its assets are cash, essentially. And the rest of it is what you'd expect: receivables, inventory, other current assets, property, plant, and equipment, etc. Now, one thing we've got to comment in here, Apple no longer really tells you what other non-current assets are comprised of, but it used to in the past, and so we've given you a little bit of insight on that. If you go back to their 2015 10K, you would learn that within other non-current assets, they've got intangible assets and goodwill. You may have noticed that's missing here. Well, that's buried in here. Okay. So now let's move on to the final piece of the balance sheet, which is equity. So if you scroll down here and you see that Apple has three components of equity. It's got common stock and additional paid in capital, retained earnings, and accumulated OCI. Now, you may be wondering, I would, when I see this, is like I actually expect to see four core line items on the equity section. What's missing here that I usually expect to see is treasury stock. So let's go ahead and plug in these numbers and then kind of do a little bit of investigating. How is that possible if there's no treasury stock? Some of you may have heard in the news, Apple buys back incredible amounts of shares. Apple, in addition to issuing dividends back to the shareholders, buys back $70 billion a year of shares because it makes so much cash that it doesn't know what to do with it. It gives it all back to its investors in the form of dividends and share buybacks. So where is this? It immediately raises my tentacles where I'm like, whoa, I expect to see something here, but I don't see it. So then I know I have to go do some investigating. Let's zoom out a little so we can fit it all in one screen. So let's first put in the data entry, then we'll do the investigation. Common stock and APSC. Again, this represents the historical value of all shares Apple has ever issued. Obviously, the real value of Apple shares is close to $1 trillion, not $40 billion. But this is historical cost, reflects the historical value. When Apple issued the shares, what was the value of the shares that they issue? Long before they started trading in the secondary market and leading to a massive market cap for Apple of nearly $1 trillion. All right, so the next thing is retained earnings. Retained earnings represents the sum total of all of Apple's historical net income since the moment of its founding, net of all the dividends the company has ever issued. And so it's $70 billion in 2018 and $98 billion in 2017. And then last but not least, this is kind of for those of you who are a little fuzzy on this line item and don't quite remember from accounting, this is kind of like a retained earnings line for junk that doesn't hit retained earnings. And so what I mean by that is if you think of retained earnings as the accumulated of all net income the company's ever generated, that means it's all the revenue the company's ever generated minus all the expenses the company's ever generated. Well, accumulated other comprehensive income is actually the same thing for income and expenses that don't hit the income statement. Those income and expenses that don't hit the income statement under GAAP are usually things like current losses or income from changes in the company's currency translations, right? So if you denominated something in a local currency and you got to bring it back to US dollars, well, you generate a loss on that or a gain on that. Well, that hits here. It does not hit the income statement and therefore does not hit retained earnings. And so things like hedges, gains and losses from hedges and derivatives, things that under US GAAP, they really want to keep out of retained earnings to not muddy the waters of core operations. They lump in here. And so this represents that, this is the sum total of all income and loss that doesn't sort of qualify within retained earnings. You can certainly think about this as one lump basket as sort of the retained earnings of all the company's ever income net of losses. But from a GAAP perspective, they like to keep those two things separate. We actually also like to keep those two things separate because it really does muddy the water of operations versus things that we have no way to really forecast. So I'll leave you with that. Let's just make sure that we didn't make any mistakes in data entry. And we did not. Everything kicks out to 0. We're in good shape. And so now the one thing that I do always look at when I don't see a line that I expect to see is I start investigating. I'm like, where are the share buybacks? And I'm going to zoom in so you can see this. If you ever want to really know what's going on in the statement of shareholders' equity, you can. I gave it away. If you want to know what's going on in the shareholders' equity section, you go to the statement of shareholders' equity, which is usually the next line down. And what you would discover in the statement of shareholders' equity is this is a more confusing schedule to look at, but I'll try to make sense of it for you. It shows you every line that the company reports in the statement of shareholders' equity. Instead of showing it this way, it actually shows it in columns. So let's look at retained earnings. Or let's start with common stock and APIC. And so if you recall right here, you have common stock and APIC of going from $35 billion in 2017 to $40 billion in 2018. Well, so it's actually showing you that reconciliation. It's going from $35 billion for common stock and APIC. And it says, oh, that went up by stock-based compensation, right? We issued more stock to our employees. We also had some taxes that we had to net out of that stock-based compensation. So the net increase in common stock is, a net increase of around 4 and change, gets us to that $40 billion. Okay, so far so good. Well, what's going on with retained earnings? if retained earnings on the statement of shareholder or on the balance sheet went from 98 billion to 70 billion, how did that happen? Well, it starts with 98 billion, and look at these adjustments. The three major adjustments to retained earnings are: it goes up by net income, which I would expect; it goes down by dividends, which I would expect, right? This is a sum total of all net income net of all dividends. But then it also goes down by the biggest thing, repurchases of common stock. So Apple is unusual in that rather than creating a separate line for treasury stock, as you would learn in first semester accounting, they actually bake it in within retained earnings. So that's fine. We just need to know that. We need to understand that, and that's okay. And that's it. And that's what we've got here for our balance sheet. So at this point, our balance sheet is complete. I also want to take another step back. I just did it. I want to do it again. And I want you to really understand this business. You can learn a lot just by looking at its financial statements. Apple has generated $45 to $60 billion worth of net income, so solid net income growth, solid revenue growth over the last several years. Apple's got massive cash balances. It also might be surprising for you to note that it has a whole bunch of debt. So it's, think of the rationale of that, and start thinking about that, because there is rationale, and we will talk about it later. But why might a company that's got so much cash on its balance sheet, $237 billion, why does it also borrow so much money, $100 billion? And so that's it. That's our balance sheet. That's our income statement. The very final thing that I wanted you to do is to go into the Apple 10K and locate some items that it now might seem random, but that I promise you we are going to use. And so rather than going throughout the case study, finding it, let's just aggregate it all in advance. If you were building a model, you'd probably do it as you kind of need it. But here, to make things easier for us, I'm just going to put it all here.